The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
And joining us now to discuss that jobs report is none other than Ben Emons. He is Managing Director at Medley Global Advisors. Welcome back, Ben.
Good morning, Lawrence. Thanks for having me. And by the way, it is a good Friday. You know, it's jobs day, a great job. So let's stay positive.
We'll try. We'll get to some unemployment later on. But nonetheless, that was 261,000 jobs that were added back in October. Quite a bit more than expected, but the unemployment rate ticked up a little bit to 3.7%. So we just saw the Fed raise the Fed funds rate by 75 basis points. Britain said also over there that as they raised their interest rates by 75 basis points, that they're going to see one of the longest recessions in history, a couple of years. So, how do we interpret this jobs data? It is, as we said, better than expected. Does the Fed continue to raise the Fed funds rate by another 75 basis points next month, which is, the market seems about 50-50 on whether it's going to be 75 or 50. What do you think?
Yeah, this report once again checks the box for 75. We've been in this pattern of better than expected data, both on jobs and inflation, and unfortunately for inflation, higher inflation, right? It was like worse than expected, but higher than expected. And that is that guidance that they've given us earlier in the summer, 50 or 75, depending on data. And that's what the market each time does. If this data comes out better, it reprices it back up to 75 basis points. So what you're going to see now, Lawrence, is a further pressure on treasury yields from here, moving the probability back up to close to 100% for the December meeting at 75 basis points. And that does get you to a two-year yield that's going to approach 5%. And that may not even be that restrictive given the nature of the economy and where inflation is. So I think we have more to go on interest rates, even though the Fed is already raising it at a rapid pace.
When we look at the jobs that were created, it's a lower number than what happened in September. So it gets the sense that at least that there's some cooling. The unemployment rate went to 3.7. It was expected to be 3.5. And I think people might not be so clear as to how the unemployment rate can go up if the jobs numbers went up. Of course, you can explain that a little bit as well. But nonetheless, are there any, I guess, is there any pressure that maybe just raising the Fed funds rate isn't enough for what the Fed can do? Would they need a little bit more quantitative tightening, i.e., maybe accelerating what they're selling off on the balance sheet?
Maybe we'll get to that last lender of resort idea, because in essence, monetary policy uses one tool. That's what they say blunt, but it is blunt in the sense, you raise the Fed funds rate closer to the rate of inflation. That's considered to be really restrictive. But I do think that if we get to that point, we really are with a Fed funds rate well over 5%. And then corporate bond yields and municipal bond yields and all that will be even much higher. And so to your point, like this job report shows, moderation of that excessive growth. The leisure hospitality component, for example, is really decelerating. So that's definitely showing that the reopening has matured and that all that momentum is somewhat slowing down. But it's still a really good report across the board. And the unemployment rate is rising because there is this movement between these two surveys, the establishment survey and household survey, but technical. But net it led to more people coming in. That initially pushes up the unemployment rate. So it's actually a positive on the labor front, but a negative in terms of interest rates because the tightness of the labor market hasn't really changed much. And that's what the Fed is ultimately looking for. So you're going to keep seeing rates going higher as the unemployment rate ticks up because of positive reasons.
What ultimately, Ben, will this have in terms of impact on the crypto markets?
So it's interesting overnight action, as you let in the segment, that is up. And I think it has actually very little to do with this payroll report, but more what's going on with China. Lots of discussion and signals that they're opening the economy or planning to. That will be very different, let's say, development against what the Federal Reserve and the jobs market is about. because then we're getting lots of liquidity coming back into the markets to anticipate this jolt of growth coming from China onto the world, right? Whether it's in commodities or whether it's in trade. And so that will be, I think, driving for crypto more that effect, as opposed to this central bank tightening campaign, because it's really interesting to see since June, when the Fed really started to move to this pace of 75 basis points, that Bitcoin has been in this tight range of 18 to 20K, not much movement with lower volatility. So it looks to me the crypto market is decoupled from Fed policy and tightening in that story, and more looking at the economics. And I think the China reopening will play a bigger role in the direction of crypto.
Nonetheless, Ben, there are some funds that are reassessing their commitment to China because of this idea of zero COVID policy being enforced with President Xi's third term. That basically China is going to be a more closed economy, whether we like it or not. And by closed, I mean literally closed. That stores and commerce and factories will be closed because of this radical zero COVID policy that the rest of the world has moved on from. Does that potentially have an impact on? Do you think that if they continue with that there will be some sort of impact in how central banks deal with their inflation, given that you have one of the largest economies that maybe sat in recession? And number two, does this also mean that what do you think is in terms of the credibility of the Fed to conquer inflation? Do you think that they have it in them, or that this is not the Fed to do it?
So in China, there's actually two things to think about, Lawrence, in the sense of that if it stays closed, say, for a long period because of the zero COVID, and it's sort of kind of a similarity of what we're trying to do with central bank policy is bring inflation down. Zero COVID is really that similar type of policy. We must bring the virus down with that policy. We must keep at it until the virus is really down, right? So that's why China is approaching this. Even though overnight, by the way, there's some discussions with Germany that they will use BioNTech and Moderna vaccinations for foreigners coming in, and also looking at to distribute more widely in China. So that could be a game changer at some point. Okay, they keep the economy closed. That has a major impact still on the supply chain globally. Because if China does reopen more materially, then the supply chain easing that we've already seen coming through will be significantly eased. So that still keeps supply tight. Then take that to inflation and to the Fed's credibility, that has immediate impact. Yes, tight supply chains will continue to have this upward pressure on inflation. I don't think the Fed's credibility is yet completely at stake here. They've made up a lot of ground. The market gives them credibility because they do believe that inflation comes off, that will go back to the same mechanics. You raise rates far enough, you get some form of recession and inflation just comes off. That's what the market believes. So we're still there, but we are at a I think critical time. If that strategy doesn't work out and the zero COVID strategy remains in place in China, this inflation picture could potentially worsen. And then, yes, the credibility of central banks will be tested by markets.
In the last Fed announcement, Fed Chair Jerome Powell said that they were going to slow rate hikes at the next meeting or the one after that. Does this data sway direction one way or another?
It actually would not. It's too strong labor market, too tight of a picture, so to speak, in the sense that people can move quickly to new jobs. Wages stay up; they're actually again increasing. So this actually does not argue for a slowdown of the pace, and therefore, you dub it more like a 50 basis point hike, but data dependent, meaning that same guidance, 50 or 75, depending on the data. That's, I think, now can call it for 75, at least based on this report. We'll see what happens with CPI next week. But the ISM data that came out yesterday showed broadening price pressures in the service sector, and that will be reflected in CPI. And if you look at the average hourly earnings in this payroll report, again, upward pressure. So inflation is actually broadening and stickier. So it's hard to get away from the 75 pace at this point, even though at some point they will, obviously, because you would expect the economy starts to really slow down. That makes the argument for slowing down the pace, but just not exactly there yet.